All right, let's get right into it. While you've probably been hearing all about AI writing poems or creating art, it has quietly taken on a new job in, well, probably the most high-stakes environment imaginable, Wall Street. And this isn't some far-off sci-fi thing. It's happening right now, and it is changing global finance way faster than most of us realize.
And yeah, this new employee, it's just different. It never sleeps, it doesn't take coffee breaks, and it can process more information in a single second than a human could in their entire lifetime. And look, we're not talking about some small-scale experiments in a back room somewhere. This is happening now, and it's being deployed firm-wide at the biggest, most influential names in the business.
The scale of this is just staggering. It's basically an all-out arms race. I mean, from the huge investment banks like Goldman and JP Morgan to massive asset managers like BlackRock, pretty much everyone is baking AI into their core operations. If you are a major player in finance today, you are absolutely in the AI game. And just to put a hard number on that, take Goldman Sachs. They've already rolled out an internal AI assistant to 10,000 of their employees. Think of it like a co-pilot for analysts. It's summarizing documents, writing code, checking compliance, all of which frees up the humans to focus on higher-level strategy. So why the gold rush? What is the massive promise that has every single bank pouring billions and billions of dollars into this technology? Well, it really all boils down to three things: speed, scale, and of course, finding an edge.
And we're talking about something that goes way beyond simple automation. AI-driven algorithmic trading can execute millions of trades in the blink of an eye, sure. But its real power, its real magic, is in analyzing patterns across these enormous, messy datasets. Patterns that no human team could ever possibly hope to see.
And you know, when things are calm, when the markets are just doing their thing, this is actually good for everybody. Research shows that algorithmic trading can improve market liquidity. That's just a fancy way of saying it's easier to buy and sell stuff without causing a huge price swing. It makes the whole market more efficient. But, and this is a big but, notice that key phrase "in normal times." To find that edge, AI consumes this just incredible diet of data. It's not just about stock tickers anymore. We're talking about AIs looking at satellite photos of oil tankers to predict supply, analyzing credit card transaction data to see how healthy the economy is, and even listening to the tone of a CEO's voice on an earnings call to figure out how confident they really are.
Okay, so that's the promise. But of course, there's always another side to the story, right? This is where we get into the peril, the new, and sometimes completely hidden risks that can send shockwaves through the entire financial system.
So remember that benefit of liquidity? Well, here's the flip side. When the market is under stress, these same super fast algorithms can all pull back at the exact same time. And when they do, poof, the liquidity just vanishes. And that's what can trigger these so-called flash crash style cascades, where prices just plummet in minutes for no obvious reason. And this leads us to a really fascinating and kind of scary new kind of danger called model concentration risk. You can think of it as a digital herd mentality. So just think about it. What happens when thousands of different AIs, all trained on pretty much the same data, all come to the exact same conclusion at the exact same microsecond? Well, if Bank A's model says sell, and Bank B's model and Bank C's model all agree, they all hit the button at once. And that creates this massive feedback loop that can turn a tiny little dip into a market-wide freefall. It's a huge systemic risk, and it's born from everyone's AI thinking the exact same way. But it's not just about the market as a whole, right? The risks are also really, really personal. Because this technology isn't just changing the market, it's fundamentally changing the careers and skills you need to even work there. Now, you're going to hear this line a lot from the big firms. Augment, not replace. It's the standard PR line. And to be fair, there's some truth to it. But it's definitely not the whole story. The reality is much more like a massive reshuffling of the deck. So this is what that great reshuffling looks like in action. All the routine stuff, the grunt work that used to be the training ground for every new analyst, drafting reports, pulling data, that's getting automated away. And in its place, a frantic, desperate demand for a totally new kind of skill set: machine learning engineers, data scientists, and people whose whole job is just to validate what the AIs are doing. So with all this change happening at lightning speed, you can bet the regulators are scrambling to catch up. They're basically in a race against the technology itself, trying to build the guardrails before something goes really, really wrong. And make no mistake, this isn't just a US issue. This is a global fire drill. You've got the SEC in the US making AI a top priority for their examinations. You've got the EU, the UK, the big global committees. Everybody is trying to figure out the new rules of the road for an AI-driven world. So what are they actually focused on? Well, it really boils down to three big things. First, model governance. Basically, do you even know how your AI works? Can you control it? Second, disclosure accuracy. Are you being straight with investors about how you're using this stuff? And third, and this is the big one, operational resilience. Have you built in the circuit breakers to stop your AI from blowing up your firm, or worse, the whole market? But right away, this creates a huge problem, a real catch-22. See, regulators want the models to be explainable. They want to be able to look under the hood. The thing is, the AIs that perform the best, the ones that find the biggest competitive edge, are often total black boxes. So what do you choose? Safety and transparency or raw performance? And that just brings us to the ultimate question. This isn't just about one bank's AI or one trading algorithm. The real question is, what happens when everyone is using this technology all at once? Could that in itself fundamentally change how financial markets behave forever, creating a whole new financial world with new risks we haven't even thought of yet? So, the new employee is on the job. It's not clocking in tomorrow, it's already here, and it's rewriting the entire playbook as we speak. The rules of finance are literally being changed in real time by code that we don't fully understand. So the question isn't if the game is changing, the question is, are any of us ready for the outcome?